Good afternoon, everyone, and welcome to another in our series of educational webinars here at TradeStation. Today we're going to talk about how active traders can benefit from the new tax law, presented by Mr. Robert A. Green, one of the founder of Green Trader Tax. Before founding Green and Company CPAs back in 1983, Mr. Green worked at Ernst & Whinney, now known as Ernst & Young. Mr. Green was a senior accountant at Ernst & Whinney's privately owned business department. He worked on audits and tax matters for investment companies, money managers, real estate businesses, and manufacturers. Before joining that firm, Mr. Green worked at Brout & Company, now part of BDO, which is a mid-sized accounting firm doing audits and tax preparation work. Mr. Green's first job out of college was at a small boutique CPA firm called Gang & Company that had very wealthy individuals, including leading families on Wall Street as clients. Mr. Green has made valuable relationships with some of these clients, a few of which have become the first clients of Green & Company CPAs. And to this day, Green & Company maintains relationships with Wall Street professionals as clients and friends. In this firm, Mr. Green has worked strictly on tax compliance and consulting for investment professionals, wealthy investors, traders, and money managers. He is absolutely the best person to be able to discuss how the new tax law will affect all of us. I'm Don Prattle from TradeStation, and I want to welcome all of you today for attending our presentation. Now, the question that comes up right away all the time is, are we recording? And the answer is absolutely. We record all of our presentations here at TradeStation, and barring any technical issues, this presentation will be available on the TradeStation University site, and I'll post that link in the chat panel for you in a few moments. Now remember that everything we talk about here at TradeStation is for educational purposes only during our webinars. All of the symbols, all the trading ideas that we discuss are for demonstration purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind in any jurisdiction where TradeStation affiliates are not authorized to do business. Remember that active trading might not be suitable for you because honestly it's not suitable for everyone, and options trading carries a high degree of risk and may not be suitable for all traders. We've posted in the chat panel pieces of disclosure information in those PDF handouts that you may notice. They're available in that chat panel for your reading pleasure later, at any time that it's convenient. And the question now has come up, how many days will the replay be posted in TradeStation University? Well, it will be there tomorrow, and we'll keep it there as long as it has reason to, we have reason to keep it there. We also post things in our TradeStation YouTube channel, so for posterity in our archive. If you're a TradeStation customer, the webinar will be available on the TradeStation video station on the TradeStation trading platform. So, how do active traders benefit from the new tax law? Well, I'm turning things over to Mr. Robert Green right now to help us with that question. Thank you very much for spending time with us today, Bob.
Thank you. Can everyone hear me okay? Just put a Y up on the chat area. I'm Robert Green. Good. Thank you. Let's get started. The real benefits for traders are for active traders. If you're not active, you come up short. The new tax law made that difference even greater because it pulled the rug out of investors by denying, suspending investment expense deductions. Trader tax status, which is something we talk about for active traders, is more important than ever before. All the other benefits are still in place for traders that we've been advocating for years. And there's a new one, that 20% pass-through deduction with Section 475. So everything we've always advocated, which was great, is now even greater than it was before. But you need to qualify, and people who know me know that I never say to have the tax tail wag the dog. So let's move through the slides. Thank you, Don, for the bio. Wow, you went way back. I started Green & Company in 1983. People haven't talked about the pre-Green & Company history for a while. It's nice to hear that again. I am a CPA and managing member of Green, Neuschwander, and Manning LLC. Darren Neuschwander, Adam Manning, and my other partners. They're head of tax compliance. They do a great job. That's where we prepare and plan tax returns, our core business. And Green Trader Tax is basically the publishing firm that owns and puts out all the content. And you know we generate a lot of content. It's a niche trading. Local accountants are insufficiently trained in it and give insufficient advice, which can really hurt you. So you need to be aware of what benefits you can qualify for. And oftentimes it requires an election by a certain due date. Like, for example, you had to elect Section 475 by April 17th. That's now passed. What's the next best thing since you missed the boat? Forming an entity that can elect 475 internally. We'll talk about that. Now, all the content that we put out is covered in Green's 2018 Trader Tax Guide. It's an annual guide that I write and publish every year since 1997. The 2018 edition discusses the Tax Cuts and Jobs Act, which has significant impact on investors, traders, and investment managers. Investment managers is where you trade other people's money. Trader is where you have the trader tax status. Investors is where you trade, but you come up short. And I've been a contributor to Forbes since 2010. This information is educational. It's not intended to be a substitute for specific individualized tax advice, which I encourage you to get from me. Read the content, have a consultation with me. I am not an attorney. When you need legal advice, go to an attorney. When you need investment planning advice, go to an investment manager. Where specific advice is necessary and appropriate, you should have those consultations. Robert Green and the Green Companies are not affiliated with TradeStation. They're a brokerage firm and more, and we're a CPA firm. Here's the main agenda that you signed up for. If you're in and out of positions several times a day, and that came from TradeStation when they requested this content today. They said they have a lot of clients like that. Last year's tax reform law, it's still new, the Tax Cuts and Jobs Act, could benefit you significantly when you file in April 2019. So today you're going to learn how to make the most of the new law, specifically claiming trader tax status. That is the linchpin to get the whole series of benefits. Now, you may file as a sole proprietor for the first part of the year because you're trading an individual account, and you may see the merit of setting up an LLC to file as a partnership, or it might be better for you to file as an S Corp. Sole proprietors can have business expenses. They can make a 475 election, which now is too late. That's all it does. The partnership, a new one, can elect 475 for the rest of the year, get that 20% pass-through deduction, look better than a sole proprietorship, but it cannot do the employee benefit plan deductions, the health insurance and retirement. For that, you need the S Corp. That's basically the difference in the choice of entities. So, trader tax status is the linchpin. A retail trader trading your own funds must qualify for trader tax status, TTS, to enjoy business-related tax breaks. Otherwise, it's investment-related. So, trader tax status is a business, get the golden goose. Investor tax status is investment where you get very few benefits. The one benefit you get is a long-term capital gains rate reduction, but you have to give up so much to get that. So there are carrots and sticks in the fiscal policy of America's tax code. If there's a break, sometimes there's a way to pay for the break. Well, active traders don't get many long-term capital gains. So they're really being disenfranchised from loss deductions, expense deductions. But trader tax status is your ticket into those deductions. Let's start with the investor, the default. By default, the investor tax status has limitations. By default, the IRS considers traders to have investor tax status with capital loss treatment and wash sale loss limitations. If you lost a lot of money in Q1, let's say in February, when the markets were pretty volatile, and you're nursing a loss this year, you're going to be limited to a 3,000 capital loss limitation, and then the rest you have to carry over to subsequent years to use up with a capital gain. That can really stretch out your ability to deduct losses. Now, if you take a loss, a wash sale loss, you take a loss, you get back into the position in 30 days before or after, the IRS doesn't let you deduct the loss. They make you add it to the replacement position. If you do it with an IRA, you never get the loss. So you can see as an investor, all of a sudden, losses are being limited. That's not good. Now, what about expenses? Well, for 2017 and prior years, investors may deduct investment expenses as a miscellaneous itemized deduction if more than 2% of adjusted gross income. So if your adjusted gross income was $100,000, 2% is 2,000. So if you had 3,000, you could deduct 1,000, 3 over the 2. But if you made more money than that and you were in the alternative minimum tax AMT zone, it was not deductible at all. So again, cutting room floor. Investors can't deduct education, can't deduct home office, have these limitations. It gets worse with the new Tax Cuts and Jobs Act. Starting in 2018, the act suspended all miscellaneous itemized deductions, including investment expenses. Now, this is a problem for family offices, and they're trying to navigate around it, and it's with potential pitfalls. Bottom line, all those investment expenses are suspended for a miscellaneous itemized deduction. Now, you can still deduct it from the Obamacare net investment income or the net investment tax of 3.8% if you're over the threshold of 250,000 married, 200,000 single. That's that other nasty tax from Obamacare on net investment income. The new tax law did not talk about suspending it for that purpose. Was that an oversight? We'll have to see when the IRS regulations come out. But bottom line, let's say you're a short seller and you have borrow fees. Those are investment expenses. That's not margin interest. Margin interest is still allowed. There are limitations, but it's still allowed. But investment expenses are not allowed. So if you start adding up some big expenses, which you've maybe gotten in prior years, kiss those goodbye. Don't get upset when you prepare your tax return. Get upset and do something about it now. Now, should you step on the gas to trade more to qualify for trader tax status? No, I don't think you should. I think you should trade the way you see fit. Now, also, investors cannot deduct health insurance. Those premiums are skyrocketing. They're supposed to go up even more. You don't want to deduct it as a itemized deduction over 7.5% of AGI. You might be taking a standard deduction with a larger itemized deduction. You want that adjusted gross income deduction for self-employed persons. Well, if you have trader tax status as a self-employed trader, a sole proprietor, that's not good enough because you don't have earned income. Your trading gains are unearned income unless you're a full member of a futures exchange, trading futures on that exchange, then under Section 1402I, it's self-employment income. But all you other traders, you don't have earned income, you don't pay self-employment tax, that's good, but you don't get these self-employed AGI, adjusted gross income deductions, including health insurance and a retirement plan. What you need to do is you need to set up an LLC S Corp that can pay you salary going into year end, which creates the earned income you need to have those employee benefit plan deductions. Now, let's say you say to yourself, okay, I'm just going to set up a company. Companies by default have business treatment. I don't need trader tax status. I'll set up a company. Well, it's an investment company if you don't have trader tax status. Partnerships and S corps with investor tax status pass through non-deductible investment expenses to the owners, so you didn't fix the problem. Your partnership doesn't get a business deduction with trader tax status unless it qualifies. It's going to pass through those borrow fees and other investment expenses to you on a K1. Now, investment partnerships without trader tax status, I use the term investment, also may not elect Section 475 ordinary income to qualify for that new 20% pass-through deduction. Capital gains are excluded. It's got to be 475. And the investment partnership also cannot arrange the health insurance and the retirement plan deduction. So that's no shortcut. If you don't have trader tax status, the investment company won't help you. Keep in mind that most hedge funds don't have trader tax status. They are passing through investment expense treatment. Now, some of you may say, well, Bob, I heard about the new C Corp lower tax rates at 21% flat tax rate. Why don't I just set up a C Corp? I don't need to. Maybe you think you don't have to worry about trader tax status, but you do, because what people don't realize is that a C Corp investment company without trader tax status may not deduct investment expenses at all. They never could, even before the act and after the act. Not only will there be a 21% flat tax, but there'll be a 20% accumulated earnings tax on any earnings that you leave in the entity. If you pay out a qualified dividend, that's probably at 15% or a 20% rate. So all of a sudden, 21% plus 20 is 41%. You're higher than the top individual rate. If you don't have trader tax status, a partnership, an S Corp, a C Corp is not going to help you. You need to deal with trader tax status head on and don't try to take any shortcuts on that. Here are the benefits for trader tax status. You can, and I'm going to show you how to qualify momentarily. You can deduct business expenses. They're not investment expenses. Businesses get the golden goose in America's tax code. We are a business nation. You can deduct it above the line from gross income. It's not an itemized deduction. It's not an adjusted gross income deduction. It's deducted from gross income, whether on a Schedule C as a sole proprietorship or Schedule E as a partnership or an S Corp. That's number one, business expenses. And you might have 5,000, 10,000, 20, 25,000 or more if you include the home office for business expenses, and even much more if you include education. Second benefit, you can file a timely Section 475 election to get exempt from the capital loss limitation of $3,000. If you lose $100,000, write that off against your wages or your spouse's wages. You're not stuck writing it off against capital gains only. There's no limit to $3,000 against other income. It's unlimited against other income. Actually, the new tax law has an excess business loss limitation. It's $500,000 if you're married, or $250,000 if you're single, and the rest carries over as a net operating loss, NOL, to the next year. Not as good as it used to be, where we used to do these incredible NOL carrybacks to get huge refunds right away. That's gone now under the new tax law. That's unfortunate. We fought for that, but we didn't win that one. But it's a lot better than a capital loss carryover because you can use it against any type of income. Now, so the 475, it's always been tax loss insurance over the years. Exemption from the capital loss limitation, exemption from those nasty pain in the neck war sale loss adjustments, which can be a real obstacle for traders, especially if you do it right across all accounts on substantially identical positions, including your IRAs, even Roth IRAs. That's the tax loss insurance benefit. That was it in the past, which was all you needed. Now the new tax law added a new benefit from 475. If you're not making a big income, you're going to get a 20% pass-through deduction on qualified business income if you're under the taxable income threshold, and I go through those numbers later, on likely 475 income, but not capital gains. So 475 is better than ever. You missed the boat on 417, 18 if you didn't elect it by then, but you can elect it in a new entity. And lastly, you can get those health insurance and retirement plan deductions in an S Corp trading entity or C Corp management company. If you're paying family health insurance premiums of $20,000, you can write off the whole $20,000 and not have any offsetting payroll tax or self-employment tax. That's better than a regular sole proprietor business. You just unlock that $20,000 deduction from adjusted gross income where you didn't get it before. No offsetting payroll tax. That alone justifies setting up the S Corp. Now you can also do a high deductible retirement plan, up to $61,000 if you're age 50 or older, otherwise $55,000 on a solo 401k defined contribution plan. You can do much better than that with a defined benefit plan if you're a consistent high income trader. These are big deductions, folks, that are on the table with trader tax status. Okay, how do you qualify for trader tax status? It's not easy to qualify for, and there are my rules based on trader tax court cases. Case law. We use case law. Currently, there is no statutory law. What this means is that they didn't write out the objective tests in the law. They left it to the courts to weigh in on all sorts of different cases. And if you analyze the case law, and that's how law works, again, I'm not a lawyer, but there's statutory law where there are bright line tests, and then there's all sorts of things that are not spelled out so that it has to be filled in by the cases, the tax court cases. So the leading publishers have interpreted it to a two-part test, which is still not enough for our needs. Taxpayers' trading activity must be substantial. All right, sounds good. Regular, frequent, and continuous. So it's got to be important, doing it all the time, regularly, frequently, and continuously without sporadic lapses. The taxpayer must seek to catch the swings in the daily market movements. Doesn't have to be day trading. Swing trading, you can hold up to 31 days, but you're looking for daily market movements. You're not profiting from long-term holding of investments. It's all very short-term. Your time horizon is not 3 months, 6 months. You're not going into longer-term options with a longer horizon. You're looking at days, weeks, under a month on the horizon. I fill in the rules with what I call my golden rules to give you a little bit more of a bright line type of test, although in only one of these factors is actually a bright line test. There should be substantial volume. Now, there were several court cases where people failed, but in one that won trader tax status, the Pope Court, and it's a recent case, Pope had 4 trades a day, 15 trades per week, 60 a month, 720 a year, and the court said fine to that. I've said before you needed 1,000. I've said before you needed 500. 720 seems to be a nice number in between there. I think it's a good number to go for. Substantial proceeds, Well, it's hard to define if you're trading options or if you are trading, penny stock. So it should just be substantial. Regular, define that for yourself. Frequent. I look at trade executions on 75% of available trading days. So that's close to 4 days a week. 3 days a week, it seems to be too short to me. This is at least one trade a day that you make. 2 days a week is certainly not enough. All the tax court cases that failed were 40%, 45%, 50%. You don't really see too many failures over 60%, but I like 75%. I think it's a solid number. You don't want to have sporadic lapses. It should be continuous. I use the example of the grandparent who's wealthy, who trades actively for a month and visits the grandchildren for a month, trades and then vacations for a month, on and off. If you own a restaurant, you don't shut it every other month. You keep the restaurant open. Time. I'm looking for 4 hours per day, including research and administration. Most traders have that unless everything is automated and they're not even involved in automation, and then they don't even qualify if they're not involved. The material participation rules of 500 hours a year, or 100 if no one does more, those don't apply because under the trading rule, trading is not subject to Section 469 passive activity loss rules. So there is no material participation standard. If the agent brings that up, they're off on the wrong tangent, and you bring them back in line. Again, you're looking for daily market movements. The average holding period is under 31 days. That came out of the Endicott court, and that's actually a bright line test. So if you're an options trader and your holding period is 32 days, you're out of luck. You must be under 31 days. So what you want to do is you want to segregate your investments, like your holding of equities as an individual, give up the portfolio margining, and ring fence your trading in an entity where you just do the options trading and you trade weeklies and monthlies, and you keep the average holding period under 31 days. Now, it might be weighted average. This has not come up in the tax court yet. So do it by every metric that seems to make common sense and try to be comfortably under 31 days in all cases. If in fact trader tax status is important to you, and again, don't have the tax tail wag the dog. For example, you might have very few expenses. You may not be worried about 475, and you can do other things to avoid wash sale losses at year end and wash sales with IRAs with a do not trade list. So trader tax status is not for everyone. You might have health insurance through your job or your spouse's job. You may not be focused on a retirement plan right away. You might make too much money for the 20% pass-through deduction. So it just may be that you don't qualify for trader tax status. And when you rationalize things, you're not really losing that much, and you shouldn't step on the gas to trade more to qualify. Now, next golden rule, intention. It's hard for the IRS to read your intention, but you need to have the intention to run a business. It's not just an investment activity. It's for your own account. You're not trading other people's money. And you're looking to make a primary or supplemental living, a living. Doesn't have to be primary. And even though you have perennial losses, your intention is to make a supplemental or primary living. So if you have another job, it's going to be a supplemental living. You should have a serious business set up, multiple trading devices. A lot of traders often have one or more workstations, or at least one good workstation, maybe a laptop or two, iPad, mobile devices. And they might have one large monitor with split screens, or usually they have multiple monitors. They have a serious setup. It doesn't look like your everyday investor. And it should be a material amount of capital that you have in your account. If you want to be a patent day trader of equities and securities, you need to have 25,000 minimum. And if you're trading futures, I want to see at least 15,000. But if you're a multimillionaire, you probably want to beef it up a little bit. It's got to be material in the eyes of the IRS. Now, here's what doesn't qualify. An automated trading system without much involvement by the trader in the creation of the automation. So you're not a programmer. You're an auto executive. You go out and you buy an automated program, hooks up with your broker for automated execution. You spend a half hour a day. You don't even really know what you're doing. All you know is that you heard it's a good system, back tested it, you flip the switch on. I like to use the analogy of a plane with a pilot. In this case, maybe you're in first class or you're in coach, but you're not in the cockpit. If you're a programmer and you create the automation, or if you get some automation just for execution but not for entry and exit signals, and you put in a lot of time and effort, who gets the credit? Now, a pilot flies a plane. They use a lot of automation, but they also use manual controls, and they override automation at times, and they're clearly responsible for flying the plane. You have to fly the plane. A trade copying service is not good enough, and there's been a proliferation of automation and trade copying and all these services. That may not be good enough in the eyes of the IRS. So you have to show that you are responsible for the trades. Now, similarly, if you engage an outside professional investment manager, like a CTA, a commodity trading advisor, or an RIA, a registered investment advisor for securities, CTA for futures, you're paying them to make the trades. You can't get trader tax status on that account. And any expenses that you pay that investment manager, advisory fees, are not going to be deductible. That's why if you go in a hedge fund that has a profit allocation, you're giving up some of your capital gains to give to them. So you're not looking to deduct investment expenses. You're carving off a piece of your capital gains. So the hedge fund is still a fix for that problem. Now, when you trade in your retirement accounts, that's not running a business. That doesn't count for trader tax status. So those are the things that don't qualify. Now, assess your trader tax status on your own. Probably pick up my latest guide and read chapter 1. Maybe have a consultation with me to see if you qualify. I will walk you through all the factors. And I want to hear how you sound. I don't want to just be a form that you fill out. And I call the balls and strikes as an umpire. And if I think you qualify, I say so. If I think you don't, I say so. If I tell you how you could qualify, and if you need it or not, and what to do with it. And that's how we have credibility with the IRS, so that we don't lose cases on trader tax status, because we call them like we see them, with great integrity. And it's the foundation of everything. That you're not going to build an entity house with a 475 election, with retirement plan deductions, health insurance deductions. You should not build that house on a cracked concrete foundation where you fail trader tax status. It needs to be rock solid. And if you get audited over it, don't expect the agent to understand all these nuances. So you may need help. You may need to go to appeals. You may need our help. I cover all that in the guide. Okay, wow. We got through the qualification for trader tax status. Now let's get into some of the details of the benefits. Business expenses. If you qualify for trader tax status, you can use the more favorable business expense treatment. There's a long list. What's the list for investors? 0. What's the list for business expenses? Long list. Tangible personal property like a computer. So you buy a new laptop, you spend up to $2,500. The whole thing's an expense. You don't even have to depreciate it. They liberalize those rules with the tangible personal property safe harbor election. Got to make that election when you return. The details are in my guide. All right, let's say you bought a workstation and it's $5,000. All right, no problem. You can take 100% Section 179 depreciation, write off the whole amount the first year. That does look to income from salary or the business. Otherwise, if you don't get the Section 179 depreciation, go for the bonus depreciation, which is really lucrative, or even regular depreciation. It's all very lucrative. You're getting these write-offs fast. Now, there's also amortization of intangible costs like startup costs, Section 195, organization costs, Section 248, and software. So go back 6 months from the start date of trader tax status. Let's say you qualified starting January 1st. Go back to July 1st. Some of your expenses, chat rooms, mentors that you had for trading or education, capitalize a reasonable amount up to $15,000. If you went to a trading school that cost $25,000, it's too much. Although I show you in the guide how to deal with that, how to allocate some to before, allocate some to after to get more of the deduction. And then with 195 and 248, you can, those code sections, you can get up to $5,000 expensing the first year, the rest over 15 years. Now, education expenses paid and courses taken after commencement. You started trader tax status January 1st. Remember, you're not elected TTS. 475 is elected, but not TTS. TTS is undergraduate school. Go to school, you get your diploma, you claim your diploma. There's no election. 475 is grad school. You can't go unless you graduate undergraduate school, but you don't have to go to grad school. It's an election. The TTS you're going to claim from January 1st if you have it. You can claim it for 017 if you have it. And then again, go back 6 months before that for the Section 195 and Section 248 costs. That's how you deal with education, folks. If it's after TTS, you could write off the whole $25,000. If it's before, you capitalize $15,000, expense $5,000, and deduct the rest over 15 years. A lot of details on that in my guide. I'm talking about a laundry list of deductions: books, publications, market data, online and professional services, chat rooms, mentors, coaches, supplies, phone, travel, seminars, conferences, assistants, and consultants. You name it, it's related to trading, it's a business deduction. If it's without TTS, it's a zero deduction. Home office expenses, that's one of the biggest ones. For the business portion of your home, so that if your rent is $3,000 a month and your home office area is 1/3, you're going to write off $1,000. That's a high percentage, but it might be if it's a 2-bedroom apartment and you're using one. Usually it's 15%, 20, 25%. Do it correctly and don't go overboard. If you own the home, then you're getting that share of real estate tax and mortgage interest. Great to get the real estate tax in this deduction, folks, because remember you got that SALT limitation of state and local tax from the new tax law. So this part is not limited, the home office portion, the business portion. Plus you get depreciation, and that does not upset your exclusion on the sale of the home. And I mean every cost related to your home: utilities, repairs, insurance, cleaning, every little thing that relates to your home, lawn care. Keep track of in your accounting. Margin interest expenses, you're not subject to the investment income limitation on Schedule A. And again, if you're taking a standard deduction of $24,000 married, you're not going to get a benefit of $1,000 or $2,000 margin interest expense as an investor. Much better to get it as a business expense. Your stock borrow fees for short sellers, or your exposure fees, all those costs as a short seller, you want it to be a business expense, not a non-deductible investment expense. Some brokers miscategorize borrow fees as an interest, and that's wrong. Now, let's say you created your internal use software for automated trading. Those expenses, you don't capitalize your time. That's not an expense, but all your related to power, equipment, all those, you hired a programmer to help you. You can have people who assist you and get credit for what they do, but you need to supervise them and know what you're talking about. You can't just sit in the passenger cabin. You got to be in the cockpit, for that airline analogy. Business expenses rarely include vehicles, so don't try to write off your SUV. You could do it if you own a flower shop delivering flowers, But if you're an at-home trader, you're not really visiting client companies that you're day trading. Now, one of your expenses are brokerage commissions and other transaction costs. They are not separately stated expenses. They are deductible against your trading gains and losses. So commissions are deducted from proceeds, added to the purchase cost basis, and netted out in the trading. So if you have a capital gain, you're in effect getting the full benefit of the commission deduction. If you have a capital loss limitation, in effect, some of those commissions are being deferred until future years when you have capital gains. So let's start with the different types of entities and unincorporated businesses that you would have. The first is the mom and pop business, the sole proprietor, the unincorporated business. It's not an LLC, it's not a corporation. You can just claim the TTS, the trader tax status, on a Schedule C for 2017 and 2018 year-to-date, January until May. And you should consider an entity like an LLC S Corp or LLC partnership for the remainder of 2018 and 2019 and subsequent years. The sole proprietor gives you the business expense deductions. Many active traders ramp up into qualification for trader tax status. They wind up filing an individual Schedule C profit or loss from business as a sole proprietor business trader the first year. No election is required. That's where you deduct your trading business expenses and your home office costs on Schedule C, and you report your trading gains and losses on other tax forms. Form 8949 for securities, Form 6781 for 1256 contracts like futures, and if you have the mark-to-market accounting election, Form 4797 Part 2. Now, if you want that home office deduction, you got to point some of those trading gains, the home office, to those trading gains to unlock it, because that deduction is liberalized, but it requires income. And it's a big deduction. Otherwise, it carries over to the next year. Now, a sole proprietor could have elected 475. A 2018 Section 475 MTM election was due by April 17, 2018. That date is passed, to use ordinary gain or loss treatment, and I generally recommend it on securities only. Short-term capital gains on securities are subject to ordinary tax rates. You don't get the lower long-term rate. You get the same rate as you do on your wages. And there are wash sale loss adjustments and the 3,000 capital loss limitation. The benefit of 475 is to exempt you from the capital loss limitation and the wash sale loss adjustments. It also gives you the pass-through benefit as well for the pass-through deduction, but a sole proprietor is going to have trouble with that pass-through deduction, and the entity is better. Now, I don't recommend 475 on futures traders because Section 1256 contracts get the lower 60-40 capital gains rate. 60% is the long-term capital gain and 40% is short-term. So if you're trading futures and other 1256 contracts like broad-based indexes, options on those products, and there are other items as well I cover in the guide and on our site. Automatically, it's mark-to-market in 1256, and you get the lower 60-40 rates at the highest bracket. It's 26.8% versus 37%, almost 12% less. If you make an extra 100,000 trading futures, you get 12,000 off in the highest brackets. Anyway, back to the message here. A sole proprietor can elect 475 on time, but that boat has sailed. You missed the boat, some of you. And a new entity is a new boat that can elect 475. So let's talk about the various types of trading entities. Traders should consider a separate legal entity. It has advantages over a Schedule C. Here are the entity benefits for trader tax status traders. Remember, if you don't have trader tax status, you get none of these benefits. These are for TTS traders. The business traders solidify TTS, and it looks better in an entity versus a Schedule C. I'm going to go through all these in detail next. So this is the summary slide. It looks better, and you solidify it. What do I mean by solidify? You got a better shot at using it without IRS questions or attack. It unlocks the deduction for health insurance and a retirement plan contribution in an S Corp or C Corp management company or S Corp trading company, not the partnership. The sole prop doesn't get those deductions. The S Corp does. You gain flexibility with a 475 election and revocation. You missed the boat. It's now late in the year. You can elect it, so that's flexibility. And if you want to revoke it, it's a lot easier to do than as an individual. It's the same process, but it's easier to do. And it's easier to adopt it because it's from inception. I'll go through that later. You can become eligible for the new 20% pass-through deduction on qualified business income, likely including Section 475, but excluding capital gains. You're single. You make $200,000 trading. That's your only, excuse me, you're single, you make $100,000 trading. That's your only income. Your taxable income is, let's say it's $100,000. You made a little bit more trading, deducted expenses, and had a standard deduction, and your taxable income is $100,000. You're going to get a 20%, $20,000 deduction under the new tax law on this pass-through deduction. The new tax law just gave you a $20,000 deduction. Yes, they took away a lot of deductions away as itemized deductions, but they gave you this new deduction. Now, if you make $250,000, you're making too much, you're not going to get a deduction at all. So there are thresholds. There's a lot of limitations on that deduction. We're waiting for the new regulations from the IRS, which will come late. The IRS is way overburdened. But this is a great deduction, and you want to position yourself for it. If you know you're not going to qualify for it, you take it off the table. If you know it's on the table, then you want to act to position yourself to maybe get that really nice deduction. You want to avoid wash sale losses with individual and IRA accounts. By ring fencing your active trading, where you trigger a lot of wash sales in the entity, you can avoid that problem with your IRAs and your individual account. You can get asset protection, greater in some states, less in other states. And by having your spouse involved, you have business continuity. These are the main benefits of the entity. Let's go through those one at a time. It looks better. An entity return consolidates trading activity on a pass-through tax return, Form 1065 for partnership S Corp 1128S, making life easier for you and the IRS or your accountant. Remember, the Schedule C just had expenses. That's a red flag. There's no income on the Schedule C. You could trigger an exam if you don't have a good footnote. Even if you have 475 ordinary income, that's on Form 4797. I do show you how to transfer some gains to zero it out, but it's still not as good as what a partnership or an S Corp return looks like, where all the income is on page one with 475, and there's the expenses and then net income. So it looks a lot better. And it's important to segregate your investments from business trading when claiming TTS on the entity, as opposed to mixing up the IRS with all of your investments. They look at, well, geez, this person has a lot of investment accounts, investments. They also have trading. It undermines, but trading individually undermines trader tax status by ring fencing the active trading in an entity. It just looks a lot better to the IRS. They don't look at the entity return and the individual return side by side unless it's in an exam. Well before that, those returns go separately. They're needles in a haystack. Next, deduct health insurance premiums and retirement plan contributions. On the officer compensation, a TTS S Corp may deduct family health insurance premiums. Let's say they're $20,000 and it's going up. and a solo 401k retirement plan deduction up to $61,000 in 2018, including the $6,000 catch-up provision for age 50 or older. Otherwise, it's $55,000. Your total employee benefit plan deductions might be $81,000. If your spouse works here too, you could go up another $18,500 or $24,500 for the elective deferral of a solo 401k or the maximum amount. It's a huge deduction. That leads to several $1,000s of income tax savings in excess of payroll tax costs. Now, on the compensation, you're going to owe payroll taxes, and those are limited. The FICA is limited to the Social Security base of $128,400. After that, you don't pay FICA. Medicare, you may be paying anyway because you're paying that investment tax. You're deducting half the payroll taxes. The payroll taxes are not bad. You're replacing income taxes with payroll taxes, which give you benefit in retirement. The income tax savings portion, depending on what your tax bracket is, depending on what state you live in, if you pay state taxes or not, that blows away the payroll taxes. That puts thousands of dollars in your pocket net. Now, a sole proprietor or partnership TTS trader cannot have these employee benefit deductions related to trading gains, which are not self-employment income. So you need the S-Corp trading company, or in some states and jurisdictions, in some cases, you might have a dual entity solution, a trading entity, and a C-Corp management company. You work out those details with me in a consultation. And then you form the entity with us afterwards if you'd like. The Section 470, and our outside attorneys who do all the legal paperwork. The Section 475 election benefit. Entities help traders elect 475 later in the year after the 417 deadline. You do it internally within 75 days of inception. That's what you do if you miss the individual deadline. You might have elected on as an individual, and now you want to form an entity for these other benefits and elect on the entity too. It's easier to enter and exit. It's more convenient. You're adopting 475 from inception internally. You don't have to file the Form 3115 with the IRS. If we prepare that for you, it costs like $300. It's a complex form. A new entity that adopts 475 doesn't have a 3115. And remember that 475 in the S-Corp or the partnership can deliver that 20% pass-through deduction. You're going to ring fence trading in the entity. If you trade and invest in substantially identical positions, i.e. you trade Apple with 475 MTM, but you also invest as an individual in Apple for long-term capital gains. I'm saying it's wiser to ring fence the trading positions inside an entity and to retain the investments individually without the entity by doing everything on the individual level and electing 475. You're giving the IRS a ticket to cause havoc, to recharacterize your unrealized or long-term capital gains, so you can't defer capital gains, to grab it into mark-to-market, or if it's better for them, to recharacterize ordinary losses that you have in Apple as a capital loss. So don't give the IRS a chance to cause havoc. Ring fence with the entity. It helps distinguish trading from investments for the qualification standards of trader tax status too. You remember I talked about that before. You definitely want to go for this 20% pass-through deduction. That's a big benefit in the new tax law. The 21% corporate tax rate for the big corporations and the 20% for the pass-throughs, the 20% deduction. So the Tax Cuts and Jobs Act created a new 20% pass-through deduction on qualified business income. We're going to wait for the IRS to define that a little better than the code, the new law. We make a case that it likely includes Section 475 ordinary income. We want to see that confirmed in the regulations. And the same goes for 4X 988 ordinary income. The new law did exclude capital gains. We have some long shots we're going for, but let's stick with what's conservative and what we expect. A TTS trading business is a specified service activity. They named trading activities in the specified service activity. So that means right off the bat, you're not getting as much of a benefit as a manufacturing company. So the individual owner of a service business, trading, investment management, must have taxable income under $315,000 married or $157,500 other taxpayers single. So your spouse makes $100,000, you make $100,000, including your trading gains. You're going to be under the 315K. You know you want 475 anyway. You don't have capital loss carryovers to worry about. You go for the partnership of the S Corp. You don't need the health insurance and retirement. You have those in your jobs. You go for the partnership. You put yourself in place to get that 20% deduction, which might be $20,000 if it's on 100,000 trading gains. It's a big deduction. Now, the deduction phases out at 100,000 married above the 315K up to 415K, and if you're single above the 157.5 up to 207 by 50,000, 207.5. Now, once you get above the normal threshold of 315K, 157.5, and you're in the phase out range, then this very tricky wage limitation also kicks in. But if you have wages in your S Corp, you're still good to go. I don't expect you to follow me on all these weeds here. Bottom line, if you're not making a lot of money and you're under these taxable income thresholds, you could position yourself for a really nice deduction here, and it's certainly worth pursuing. Now, I keep mentioning pass-through. Here's how it works, and there are state considerations, state tax consideration. A pass-through entity, for those of you not familiar with it, means the entity is not a tax, the entity is a tax filer, but it's not a taxpayer. So you're filing the partnership return with all the details, or the S Corp return with all the details, but you're not paying any federal taxes unless you had built-in gains from before when maybe you converted from being a C Corp. That's not going to be the case for a new entity. So you are filing a tax return, and there are due dates and penalties for being late, but you're paying the taxes on the individual level. The owners are the taxpayers, most often on individual tax returns. Now you need to consider marriage, community property in some states, where your state residence is, what the state tax rules are, including annual reports, minimum taxes, franchise taxes, excise taxes, payroll taxes, unemployment insurance, and more. Now that sounds like a mouthful of trouble, but it's not. What does that add up to in most jurisdictions? $100. So it's de minimis. It's nominal. But in California, there might be an $800 minimum tax. There's a 1.5% franchise tax on S Corps. In Illinois, there's a 1.5% replacement tax on S Corps, not on trading partnerships, which have the investment partnership exemption. New York City doesn't acknowledge S Corps. They treat it as a C Corp. Some states have scary sounding excise or franchise taxes, but in almost all cases, they don't apply to a trading business. Or if they do apply, there's very, very high thresholds that you're not going to meet. Don't be scared off by those terms. In most cases, you're not subject to state unemployment insurance. If you are, it's a few $100s. The income tax savings is going to dwarf these costs. And I will tell you what these are in your jurisdiction. There is no tax benefit in forming your entity in a tax-free state like Delaware and Nevada. You're going to be passing through the income to your home state anyway, and the home state will know about it. And you live, work, and trade in your home state, so you need to register the foreign entity in your resident state anyway, which means that's the same as if you had formed in your home state to begin with. Now you're stuck with the redundant costs of Delaware and Nevada. Don't try to hide from California and Nevada or from New York and Delaware. You're going to get busted on that. It won't do you any good. It doesn't save any taxes. It's a misnomer. I write about that more in the guide. So your entity is going to give you a Schedule K1. And we're almost done with the slides, and we're going to go to Q&A. We went a little bit over here. TradeStation's been good on that in the past. We're not going to be much over. So let's finish up the slides. Schedule K1s. They report all the entity trading gains, losses, and expenses on the entity tax return of Partnership 1065 or S Corp 1120S. Issue the Schedule K1 to each owner for their respective share of each item of income or loss. Don't omit that. There's penalties for missing that. You got to issue the K1s to the owners. For example, the entity can pass through capital gains to utilize individual level capital loss carryovers. Or the entity can pass through 475 ordinary losses to generate tax refunds on the individual level. Or they can pass through 475 income for the 20% pass-through deduction, which is assessed on the individual owner level. That deduction is not on the entity level, it's on the owner level. It's not an AGI deduction, it's not a business deduction, it's not an itemized deduction. They squeeze it in above the itemized deductions, but below the AGI deductions. So you can still utilize your capital loss carryovers. Don't worry, you don't lose those on the individual level. They keep carrying over on your individual Schedule D, and the entity can pass through capital gains to use them up, and then you can elect 475 in a subsequent year by March 15. So here are the types of entities, and we're almost done with the slides, only a few more. And learn the pros and cons of each type of entity. So you got your limited liability company. That's the one I prefer the most in most states. The default tax treatment for a spousal LLC, limited liability company, is a partnership return. You can also have a single member SMLLC, but by default, it's a quote-unquote disregarded entity. That means it's a tax nothing in the eyes of the IRS, which means an individual-owned SMLLC, which qualifies for TTS, is back to filing a Schedule C, which is what we're trying to avoid. We're trying to get out of the Schedule C into an entity return for all the benefits I talked about. Now, a single person should consider a single member LLC with an S Corp election. And a multi-member LLC can also elect S Corp tax treatment within 75 days of inception or by March 15th of the current year. So if you have a spousal LLC that you're forming or a single member LLC that you're forming now, you can file the S Corp election within 75 days of inception to Form 2553. Most states accept the federal election. A few require its own form, which is no big deal. So TTS traders that want those employee benefit plan deductions should consider the S Corp election, Form 2553, to unlock the employee benefit plan deductions. LLCs and corporations may elect S Corp status. They don't have to. Even a general partnership that does not have liability protection, it can elect S Corp status in every state except Connecticut, District of Columbia, Michigan, New Hampshire, New Jersey, and Tennessee. But I kind of prefer the LLC over the general partnership. Never have a general partnership with anyone outside of a spouse because all partners are joint and severally liable for the debts. Now, an existing entity had to file that election by March 15th for the S Corp. If it's a new entity, it's within 75 days of inception. Here's a few S Corp tax return tips. When you go to deduct the officer health insurance, you add the premiums to the compensation, and then you deduct it on the individual return, and there's no offsetting payroll tax. It's a little quirky, but that's how you get the deduction. If profitable, you consider the retirement plan based on officer compensation. The solo 401k plan, which I like, has two components. The 100% deductible elective deferral up to $18,500 plus $6,000 more if age 50 or older, and a 25% deductible profit sharing plan up to $36,500, And the income tax savings generally exceeds the payroll tax cost by several $1,000s. You work that out with us going into year end. You have your S Corp. You see what your profits are in December, because you might have made money earlier in the year and then lost it. You see what you want to contribute to a retirement plan, what it saves you in income taxes over payroll taxes, and then you execute the plan accordingly. That's the year-end tax planning. And that's what we do with the entity. That's crucial. So again, just to wrap up, you got your trader tax status, sole proprietor year to date. You want to consider the LLC partnership or the LLC S Corp. Forget the C Corp because of the excess taxation, accumulated earnings tax. You make the choice with me in a consultation. We figure out what's best for you based on your custom facts and circumstances. So if your passion is trading, you want to consider a trading business structure with maximum tax advantages customized to your needs. So I'm going to get to your questions in a minute, but thank you for attending the webinar and watching the recording later at TradeStation or on their YouTube channel. Come to Green Trader Tax for more information. There's a great tax center. There's other premium content. Give us a call, 203-456-1537, or the toll-free number. Chat with us. Send us your emails. If I don't get to your questions today, send your email questions to info@greentradertax.com. I'll get to them today or tomorrow. And then come over to our website and let me now answer some questions on the board and see if I could see those. Now, Don, should I just look on the chat screen?
Hi, Robert. So, yeah, let's go back to the top. Questions will keep coming in. I can help with some of the questions. Now, at the very beginning, folks were asking again about the recording. It will be available tomorrow in TradeStation University. We're not providing the slides for the presentation, although Robert certainly has, materials that he'll share with you from his website. So the first question is, let's see. So Scott is asking, what about, or Linda is asking, what about swing traders? Are they considered investors? And the answer
Swing
there.
traders can qualify for trader tax status. You don't have to be a day trader. If you're a swing trader with 1 week to 2 week holding periods or less, that can still qualify.
Okay, so this would change trading status from non-professional to professional. That's the next question.
No. Professional status means you have a license or an entity account. And TradeStation may be one of the brokers that does not charge a higher data feed fees. That's up to your firm, Don.
Right. So we'll take that up.
Sometimes entities have to pay higher pro rates.
Yeah, all they have to do is take that up with our customer service line.
Right.
Let's see about the webinar. Are you trading? Even do these regulations apply to you even if you're trading as an S corp?
Yes. Entities need to qualify for trader tax status. That was one of the big messages up front.
Gotcha.
An investment company does not cut the mustard.
Right. So then I'm sure this question was asked before the slide about does the new tax law define active trader? You certainly took your time to do that.
No.
What are the prerequisites again to get the TTS status?
Volume, 4 trades a day, 15 a week, 60 a month, 720 a year. Trades of 75% of available trading days. That's about 4 days a week. Look at the number of days the markets are open. Take out personal days, holidays, sick days, vacation days, and get to 75%. And then I went through all those golden rules, which are on our website and in the guide.
Okay.
There's a whole long list.
There was a question in there that were these regulations applicable in Canada? And I pointed out that this was a U.S. tax code presentation.
No, this is U.S. tax code, right.
And then another clarification, someone needing clarification about, was the trader considered a business?
Yes, trader tax status is synonymous with being a business, but not so-called business income, business expenses. It's still the buying and selling of capital assets, which is important in many jurisdictions if there are ever like gross receipts type taxes. We argue that it's not gross receipts. But if you want ordinary gain or loss, business loss treatment, then you make a 475 election. So there's a lot of nuances to that terminology.
The okay, so round trip constitutes two trades. That's an easy one. Yeah, that's two trades.
No, we count total trades, the open and close separately.
Right.
One round trip trade is two total trades, and my numbers are speaking to the totals. So if I'm looking for 4 total trades a day, that's 4 buys, or it's 2 round trip buys and sells.
Right. Now, this might be the question I asked you back in our previous webinar that we had, our presentation that we did months ago about futures trading and how futures trading is affected here. And the answer
Futures
is
traders also want to qualify for trader tax status. They also want the entity for the employee benefit plan deductions. But if they're profitable, they don't want the 475 election to retain the lower 60/40 tax rates. That makes them ineligible for the 20% pass-through deduction. But I think the 60/40 benefit is better, and it's more concrete at this stage as we await regulations on the new 20% pass-through deduction.
okay. Forex trades, how are they affected?
Forex is Section 988 ordinary gain or loss, so you can qualify for the pass-through deduction.
Okay.
But we recommend that Forex traders make a capital gains election to, in some cases, on majors only, get into the lower 60/40 tax rates of Section 1256G. So come to our tax center. You can see it on top of the website here. Scroll down to information on financial products, and then there's a lot of information on Forex. I can't show it because I don't have the website open live. I just have this PowerPoint slide showing a screenshot.
I think that gives a pretty good example of how to get to the site. So if you're currently under trader tax status using the 2017 tax law, do you need to reestablish that status under the new tax law?
No.
All right.
Every year, you put the bread in the oven on trader tax status. If it rises to bread, it's bread. If it's not, it's flatbread. So you claim trader tax status each year based on the facts and circumstances. But you elect 475, and if you have trader tax status the year you elect it, you must use it. And then 475 hangs on your back until and unless you ever revoke it. And you probably wouldn't want to revoke it unless there are some certain circumstances. So TTS is assessed each year and claimed. 475 is elected, and then it hangs on your back, and whenever you have TTS, you use it. And when you don't, you can't use it.
Okay. Are IRS audits more frequent using the TTS?
Yes, but frequency of audits are at historically low numbers, and our clients have audit rates way below average business rates. They're very low because, first of all, we call the balls and strikes very carefully, and we have very good footnotes, and we don't file returns with red flags. So, yes, it raises, if you have a return that has lots of crazy stuff going on, and you're pulling a fast one on the IRS and you're weak on trader tax status, you want to stay clear. But if you're above board and file correct tax returns and you qualify for trader tax status, you absolutely should use it and report things properly, set the precedent, because you might need a huge tax loss insurance this year and you want the precedent of using it last year. You don't want, we had a lot of people that came to me before April 17th to make a 475 election because they had losses in Q1 with the market volatility before they recovered. And they wanted the ordinary loss treatment. And it was important to set the stage of claiming it for 2017 as well, even though it was capital gains and loss treatment in 2017. So go for what you're entitled to, but do it properly.
The James had a question about how many months in the year would you need to meet these requirements in order to be considered a trader for 2018?
Well, technically, you can open and close a business in a short amount of time, but there's something called the Chen case, where Mr. Chen tried to pull a fast one on the IRS. He never elected 475, but said he did, so he was cheating the IRS. Once he realized he lost that, he capitulated on trader tax status. He had a full-time job, and he only traded for 3 months, and the IRS said that wasn't long enough. I probably could have won the Chen case on trader tax status, but I wouldn't have tried to win on 475 because he was cheating, and I would have told the IRS that right off the bat that he didn't have 475, and I'm sure he may not have hired me for that reason. But in any event, I like the period to be a lot longer than 3 months. It doesn't have to be a whole year. So for those traders who had a Q1 loss with 475 and who may have stopped, it's a lot better to say, hey, I had it for 15 months for all of 017 too. So it is, I don't think you should try to, if you had it year to date with a 475 loss, I don't think you should keep trading actively just to keep a longer period of time, because that could lead to losses. So speak with me about it. And if you start the trader tax status in November, it's really too late. Q4 is okay, October 1st, but November is too late.
There were a couple questions when you were covering the idea of the automated trading setups that customers have themselves in. So Rex has asked, what is the automation? What if the automation is for entries only and he closes the trades manually?
Well, if you don't have involvement with who gets the credit for the trade, ask yourself, who gets the credit for the trade? Is it the software or you? Did you really think of the trade and make the trade? I mean, if you could have automated execution and just decide not to and just press the button without putting any thought into it, I could see how the IRS would deny trader tax status. So I think if you create the software, then you're creating the Frankenstein, the trading program. So you have to be able to claim credit in some common sense way.
Gotcha. So let's see. So then there's a question about a specific education provider trading like Chuck, who the subscription trades take place within an IRA. I think that's the same answer, right? So if these are auto trades,
well, the IRA does no trader tax status anyway.
I see.
But if more and more people brokers are working with platforms and automated trade copying services, automated services, and traders take a shot at trading, maybe don't have great success, and then they want to benefit from ride other people's coattails. If the IRS thinks that you're not really responsible and the other person is, they're going to attack trader tax status and maybe win in tax court. So you have to be able to claim credit. That's the overriding message.
Got it. Baloo makes a comment that the toughest part is to qualify for trader tax status and the rest is easy.
Right. Yeah, I mean, when you build a house, that concrete foundation is not easy.
A couple of, the tone of this question is, do I have to report my profits every year? This individual is afraid IRS might see it as a hobby. I guess.
Well, first of all, you always must report all your income of any kind worldwide.
Right.
That's number one. Number two, hobby loss rules do not apply to a trading business. Oh. Don't tell the IRS you love trading. It's a hobby. It's recreational for you. The fact is that if it's not recreational or personal by nature, then the 3 out of 5 year or 2 out of 7, those presumption of profit rules do not apply. If it's horse racing, if it's gentleman farming, if it's a classic recreational or personal activity, that's where the presumption of profit rules kick in. But otherwise, they don't apply. So you could have losses 5 years in a row and still get the loss. So if they raise hobby loss rules or Section 469 passive loss activity rules, they're on the wrong track and you need us to get them back on the right track or do it yourself, and I cover that in my guide.
Got it. Let's see. So,
and you can see the guide right there on the home page there.
Right. Sanjeev said he applied for 475 election this year. Is it still advisable to apply for an S Corp?
It may be if you want the health insurance and retirement plan deduction and a better shot at the 20% pass-through deduction with 475. Technically, a sole proprietor trader with 475 should be entitled to the pass-through deduction, but my partner is concerned the IRS may bounce it because there is no income on the Schedule C, and we think it should sail through on a partnership or S Corp return. So read the content and maybe have a consult with me.
Actually, I'm glad you said it right there. There is a request for your what is the right email address that I'll post in the chat panel?
So the info at and I'll go back a slide. It's right here. The info at greentradertax.com.
Got it. So that's how we would get started with a consultation. Luis asks, what if he's a U.S. citizen, or what if he is a U.S. citizen and he's trading from Mexico? And the next comment was he should move to Texas.
Okay. U.S. citizens are taxed on worldwide income. Go over to the tax center, drop down, go to international tax matters. Whether you're in New Jersey or the Isle of Jersey, which is a tax haven off the coast of the UK, you're taxed on your worldwide income on the underlying income in your brokerage accounts. And you have to report your foreign bank accounts if you have more than 10,000 in any collection of accounts at any point during the year. So you're not getting any tax deferral offshore. And if you live offshore, you might be able to open an offshore Forex trading account where you have more trouble as onshore. Now, U.S. residents abroad can get an extra benefit, an extra employee benefit plan deduction, the foreign earned income exclusion and housing allowance, where you can exclude up to $104,000 of income. Same drill. You pay compensation, you unlock that deduction. That's beyond the scope of today's presentation. Go to the guide to read about that. That's a really nice benefit to consider.
Okay. Kelly brings up, I think this is just under discussion, the fair tax HR 25, which goes back to a national sales tax and luxury tax like before the 16th Amendment. It eliminates the income tax, estate tax, and requires no filing of any kind, pay or tax at the cash register when buying new items.
Well, let me stop you for a second, Don.
Yeah, go ahead.
Let me just jump in there. A financial transactions tax has been threatened around the world. It took hold in the EU, but kind of collapsed there. It hasn't fully collapsed yet. Progressive Democrats have proposed it at the fringe in America. It was shot down by President Obama and Secretary Geithner of Treasury. Republicans are dead set against it. Financial transactions tax has the power to put all active traders out of business. It's a tax on every gross receipt and every purchase. And even though it sounds small, it wipes out their profits. And I had a very successful petition to Congress years ago, and close to 20,000 people signed it. And the message was loud and clear, and I fought against it, and we won. And hopefully it's not brought back to life. Even Illinois has tried to do it just for Illinois. But hopefully the brokers fight against it as well. Because Main Street traders are your mom and pop businesses, the people on this call. This is not Goldman Sachs here today, Don.
Right.
So why should our mom and pop businesses be put out of business with a financial transactions tax?
There you go. So what about the compensation as an officer of the entity? What's the standard? I don't remember.
Unlike an earned income activity like a law firm or an accounting firm or a consulting business that uses an S Corp, you don't need reasonable compensation currently proposed at 25 to 50% of net income. You can have zero compensation, although it looks better to have some. At a minimum, we have the health insurance on the W-2, and then we add compensation to unlock the retirement plan, we focus on the elective deferral of 18,500. So you'd have wages of 18,500, 6,000 more if you're age 50 or older. That's where you get the main tax benefits. And above that, we go into the profit sharing plan, which takes your wages up to 146,000 times 25% deduction for the 36,500 contribution. So that's kind of the guidance, and that's covered in the guide as well.
Okay.
There's a whole chapter on the retirement.
Now, what about futures traders in the S Corp?
Same drill, same thing. No matter what you trade, it can come into the picture for trader tax status, but there are different types of elections that apply to different things that you trade. So you elect 475 on securities only, you stay in 1256 for futures, you file a capital gains election on Forex. On your crypto, you're stuck with capital gains and losses currently unless the IRS changes to call it a security, and then 475 could apply. So there are different elections for different things you trade, but it can all be part of your trader tax status, all done in the same entity.
Now, looks like this question is Robert's probably going to need or Thomas is probably going to need a consult with Robert. He has an S Corp. He has a $53,000 carryover into 2018, but he has already made over $100,000 this year. Should he wait until 2019 to change to the trader tax status?
No, he should claim the trader tax status for the business expenses, but hold off on the 475 election because he wants to pass through capital gains to soak up his capital loss carryover.
Okay. Anish is asking what the yearly fees are for your services.
Well, if you go to services in the drop-down menu, you'll see consultations, accounting, entity formations, and tax compliance. Tax compliance is our core business. For a trader, the upfront payment is $790. The total cost might be $1,000, could be $1,500, could be $2,000. Depends on what's involved. My partner gives you a price quote. We have our fee schedule online.
Okay.
If you're not without trader tax status, it could cost several $100s less. But usually clients sign up because they're close to the fringes or have trader tax status. That's where we add the most value. And also, if you have business treatment, it could be a business deduction because below the line, tax compliance fees are no longer deductible, but ours as a business deduction are. Those of you who have questions to see if you qualify for trader tax status, if an entity can help you, which type of entity, we offer a 45-minute paid consultation with me. You get access to my calendar. You pick the time and date, usually within a day or two of when you purchase it. That costs $250 currently, and you end up with a memo from me on what I think you should do based on your facts and circumstances. And then we have the entity formation service for setting up trading entities only. And that's all, and we have an accounting service. It's all explained on the website under services. Thanks for asking.
There are a number of other questions, and I am going to recommend that all of you folks that you consider sending. I want to back up the slide here. Sending that question to info@greentradertax.com if we haven't gotten to it. I'm going to round out our presentation today with there's two questions at the tail end here where Tim has paid for Rule 1 class. Oh no. For Rule 1 classes for 1.5 years with the IRS qualify him. I suppose.
I'm not sure what he refers to. Yeah, so
yeah, Rule 1 is a subscriber service, and financial services educator. You may want to direct that to Rule 1.
If you're an educator that's not trader tax status, that's a different business treatment.
Right.
Where you would claim business status. That's not trading.
Right. Now, retirement 401k deduction passes to the taxpayer's 1040 when you convert the 401k to a Roth that is taxed at ordinary income on the 1040 or in the entity.
Yes. Yeah. In the 1040.
Okay. All right.
And I cover Roth conversions in the guide.
All right, folks.
But Donna, it was a real pleasure to work with you today. I'm glad we got to all the questions, and it was nice that you read them. It was good to have another voice besides mine on the call.
You're welcome. Bob, you did a great job outlining things, and certainly for sticking with us for a number of the questions. And I'm sorry we couldn't get to all of them. But if you have a question on the slide you see right now, info@greentradertax.com, as Bob mentioned, his team will respond to you. And you'll get
I will.
Bob will be part of it. Yes, Bob will get back to you. So, but again, thank you again. You know, this is our second time this year that we worked together on a presentation, and I'm more impressed all the time. But I do, and I want to thank everyone for spending time with us this afternoon. All of you, TradeStation prospects and customers. And certainly, you know, those of you, you know, from TradeStation staff that I know that are logged in listening too. This kind of information is invaluable for everybody. But thank you very much, Bob, and we'll work on something else for the next quarter, perhaps.
Wonderful.
All right. You have a great night, everybody. We'll see you again tomorrow. Our morning market briefing tomorrow, Thursday morning. Starts 1/2 hour before the market opens, where we begin to help you get your edge on for the trading day. Price Seedley of BigTrends.com will be with us, and he will help us get started on our trading day. So you have a great night.
I'll show you on Street View.